Are you afraid of making investing mistakes? Are you not investing because you completely want to avoid any chance of making investing mistakes? In this video, I'm going to share with you 5 common investing mistakes and the solutions. This is a series that I'm doing on investing mistakes after 40 years, almost 40 years of investing, and the last 15 years creating multiple income streams from stocks, real estate, and other investments. I share what I've learned from that experience. The first mistake that I'll share with you in this video is not having an overall plan. So it's really easy to get caught up in analyzing a specific investment or making a decision about hiring a specific financial advisor without having an overall plan for what you're doing, when you want to retire, how much money you want to have when you retire, what types of investments you want to make, whether you want to have only stocks and bonds or whether you want to venture into more alternative investments like real estate or small business perhaps. So an overall plan, how much it costs you to live every year. Those are the things that you'll plan for. That will be your foundation. And when you don't have that overall plan, it makes it really tricky to invest in a way that supports what it is that you want to have in your life. That's investing mistake 1. And the way to overcome it is simply to have an overall plan. Sit down at a peaceful time and write out what you want to have, because this is really your life. I know we're talking about money, but we're talking about having the things that you want in your life and living in a way that you want to live. And so once you can define that, you can work from that and you can make it happen. The next investing mistake that I want to share with you in this video, so common, is not expecting an annual return of 10% from the stock market every year. I have people that have argued with me and gotten really mad at me on this channel because I've said that the stock market doesn't have a total return every year 10% or doesn't always return 10%. Of course, over time it does. But that's over very, very long periods of time. And if you're planning on the market returning 10% a year in your retirement planning, and let's say we've just come through a really, really strong bull market that has produced those annual returns of 10% or higher, and you're planning on that going into the future, odds are lower, probabilities, my favorite investing word, are lower that the market will continue to have those stellar returns over the next few years. That's because at some point it has to come back down to that mean. I write a lot about this at retirecertain.com, and I also have an ebook with information around this. But it's really important to understand that you can't bank on, you can't count on, you can't plan around having a 10% annual total return from stocks every year. That one's really important and really, really common. The way around that is simply to know that that's not always the case, and it's so easy to see if you look at, instead of average returns over 5 years, 10 years, if you look at what an investment did every single year, such as what did the S&P 500 index do each individual year, then you'll have a more realistic expectation of how the stock market will return over the next few years. Also, it's really important to just look at those past few years. The next or third investing mistake that I want to share with you is giving away your power around your money. This happens a lot when you feel like someone else is completely responsible for your investing. I think the important thing to realize here and the workaround here is to ask yourself this question. If I lose my money or I don't have enough money when I'm 80 years old or 75 years old to retire and live how I want, who will suffer? Will it be, my spouse? It could be a spouse. That's probably not a great example. Could be an ex-spouse. But you could certainly ask, will it be my financial advisor? Who could be your uncle's cousin, right? I hear that a lot. I hired this person because I could trust them. Well, of course, they're doing the best job that they can, but that doesn't necessarily mean that you'll have enough money for the rest of your life. So My point is, don't give away your power around your money. Understand and the math behind and the numbers behind whether or not you're likely to reach your goals, reach that wealth plan that I was talking about, so that you can live the way that you want. And speaking of spouses, divorces do happen. And so I can't tell you the number of stories I've heard where, that went south and I thought I was going to have more money, but we got the divorce and yada yada. So don't give away your power around your money. All right. And the way around that is simply to own it and take responsibility for it. Spend some time learning about it and be empowered around it. Choose to lead your wealth instead of giving away your power around that. The next investing mistake is simply to assume that someone else can invest better than you can invest. There's this natural assumption from people that, this particular financial advisor or this particular family member or whoever will do a much better job than me investing. It's usually, it could be either, really. That's not always the case. It may be that you're choosing to not be involved, but it also could be that almost, anybody can learn to invest, and it's not that complicated. And so assuming that someone else is going to do a better job than you is just not a valid assumption. And the workaround there, the solution to that, is to simply not make that assumption. It's simply to know that people do make investing mistakes, financial advisors included. You can go back and look at the returns of the most popular funds, the most popular financial advice. It's harder to see records of financial advisors, but certainly the funds that they put their clients into, you can go back and look and see that there are mistakes made by everyone. So don't assume that there won't be mistakes if you allow someone else to take care of your money for you. And then the fifth and last investing mistake I'll share in this video is simply, this is a big one, and it's a hard one, following the herd. Wow, it's so hard to go against the herd. We're people that are, culturally and just from the way our brains work and the way we're built, is we function as a herd. We want to go with the herd. We don't want to be too different. And so after this really plays out in the area of investing in cheap assets, investing in what everyone else is fearful to invest in because they're absolute screaming bargains and they present themselves as incredible opportunities to build wealth. And so when you follow the herd, you're going to do what everybody else is doing. But if you can step back and not follow the herd, it's very counterintuitive. But if you can do that, then you can find some exceptional opportunities. Let me give you a great example that I love to share. And you may have heard me say it before. My dad bought municipal bonds that were paying up to 25% tax-free income or interest in the early 1980s. And he was able to buy these bonds super, super cheap because everyone was afraid of buying these bonds. So by thinking differently, my parents were able to change their lifestyle simply from this one investment, by not following the herd and by being aware of the opportunities that these bonds presented at the time, which ties over into so many of the other investing mistakes that I've shared with you in this series. So that's what I wanted to share with you. Yeah, these 5 investing mistakes, made a lot of them myself. I've learned over the years. Every investor makes mistakes. Anyone that says that they haven't I don't think anybody would even claim that, right? Come see me at retirecertain.com. If you like this video, please click the thumbs up button below the video. Let me know that you liked it. I love it. And subscribe to my channel. Thanks for watching.